Hi, thank you for watching Digging to China. I'm Dong Shang. If you have not done so already, you can pause and subscribe to my channel. Thank you so much. A study by the Institute of International Finance found that China has been experiencing unprecedented capital flight since Russia invaded Ukraine. It is an embarrassing fact for Beijing. What's more insulting? The study found no similar outflows from other emerging markets. While Chinese shares comprise 9% of global equity values, but mainland China listed companies constitute only 2.7% of international investors' fund in 2020. Why is that? One, Beijing's policymaker has been unpredictable. Two, Chinese stock market shareholder base is dominated by day traders, and this fact scares off serious financial institutions. Chanos, a hedge fund manager, once referred to Chinese market as a roach motel, easy to get money in, hard to get it out. In order to attract global portfolio managers in the last couple of years, Beijing had started to make progress. For example, it mostly stopped arbitrary trading halts. Money managers have found it is easier to repatriate funds at will. Because of these efforts, despite the trade war and the pandemic, passive index providers started to include onshore Chinese shares and bonds in their benchmarks, and international funds began increasing their China exposures. That being said, investors were traumatized by 2 years of rambling crackdowns on listed companies. Now comes the Ukraine invasion, which may be giving them reason for pause. War is pushing up commodity prices, and if Beijing forces its local companies to help Russia evade sanctions, U.S. retaliation seems imminent. Chinese stock exchanges are the world's worst performing outside Russia, with daily average outflows touching nearly $500 million at one point. Pension funds and insurers often buy and hold assets for long periods of time, although their investment total is small in absolute terms, but their presence helps anchor market valuations and reassure local traders who tend to distrust local analysts and ratings agencies. Chinese state media always presents global investor enthusiasm for China as endorsing its authoritarian government. An exodus of pension funds and insurers will be painful. If the capital flight is sustained, it could aggravate the current sell-off at a politically sensitive moment. President Xi Jinping is set to be elected to a third term later in the year. For reformers, it marks a setback in Beijing's campaign to woo international money. President Xi Jinping's friendship with the Russian leader Vladimir Putin has made investors more distrustful of China. The central question is, what would China willing to go as a country to achieve its leader's goals? As a result, some international investors are finding an aggressive allocation to China undesirable. Outflows from China's stocks, bonds, and mutual funds accelerated after Russia's invasion of Ukraine. While Norway's $1.3 trillion sovereign wealth fund has snubbed a Chinese sportswear giant due to concerns about human rights abuse, US dollar private equity funds that invest in China raised just $1.4 billion in the first quarter, the lowest figure since 2018 for the same period. Last Monday, China published better-than-expected economic data. However, analysts point to inconsistencies with alternative statistics that paint a grimmer picture of the economy. Simon Edelson is the manager of UK investment firm Artemis Investment Management. He said the scale and the speed of sanctions imposed on Russia forced a rethink of Western attitudes to China. His team at the $37 billion money manager sold all its China investments last year following Beijing's interventions in high-profile listings like DD Global and Ant Group, because such moves threatened shareholder rights. China's more assertive rhetoric around Hong Kong and the sovereignty claims in the South China Sea also made the investment team uneasy. Edelstein said, politics and the governance factors should now set a cautious tone, especially for long-term commitments to China. He also added that the European measures taken against Russia show that the strong trade ties are no guarantee of diplomatic security. Brendan Ahern is the Chief Investment Officer at Crane Funds Advisors. His firm manages China-focused exchange-traded funds. He described indiscriminate and price-insensitive selling of Chinese shares by international investors in the past year. He complained that Beijing's regulatory actions felt like an attack on the most respected and widely foreign-held companies. While sanctions on Russia raised the concern the same could happen to China, his firm is replacing US-listed Chinese stocks with those trading in Hong Kong to reduce risk. Making money in China's public markets has become more difficult. The CSI 300 is a capitalization-weighted stock market index designed to replicate the performance of the top 300 stocks traded on the Shanghai Stock Exchange and the Shenzhen Stock Exchange. The CSI 300 index of stock is down about 15% year-to-date, and its risk-adjusted return is among the lowest globally, only slightly better than Sri Lanka's Colombo All-Share Index. For the first time since 2010, Chinese benchmark sovereign 10-year notes offer no carryover comparable U.S. treasuries. Last quarter, the returns in China's high-yield dollar credit market were the worst in at least a decade. Global funds have started to pull out, selling more than $7 billion worth of mainland-listed stocks via exchange links with Hong Kong in March. They also disposed of $14 billion in Chinese government debt over the past 2 months and trimmed their credit holdings. Chinese authorities appear to be taking steps to appeal to global funds. Regulators last month promised to ensure policies are more transparent and predictable. China is also making compromises that may grant American regulators partial access to audits of US-listed Chinese companies. While Wall Street giants such as JP Morgan Chase, Goldman Sachs Group are rushing to take full ownership of their China ventures, some companies are divesting. In March, Germany's Fraport AG sold its stake in Xi'an Airport to a local buyer, ending a 14-year stint in China. The airport operator said it decided to exit the Chinese market after struggling to expand its business. Fraport also owns a share of St. Petersburg Airport in Russia, which it's currently unable to sell. Others are preparing for China's decoupling from the West. TuSimple is a self-driving technology startup. It is considering spinning its China operations off into a separate entity. American authorities have concerns over Beijing's access to its data. Chinese oil giant CNOOC may exit operations in the UK, Canada, and the US due to concerns the assets could be subject to sanctions. As risks increase and the rewards diminish, adding exposure to China may no longer be a no-brainer for global investors. In a speech last week, U.S. Treasury Secretary Janet Yellen called Beijing to account for its ever-closer relationship with Moscow. She said, quote, "The world's attitude towards China and its willingness to embrace further economic integration may well be affected by China's reaction to our call for resolute action on Russia." Unquote. Will China heed to Ms. Yellen's warnings? We'll see about that. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly.